Hi, this is Dustin with Dustin's Dollars. Today, I'm going to be talking about Tellurian, some recent updates, recent things that have happened with the company. Specifically, I'm going to talk about the Gunvor extension, the valuing Tellurian as a gas producer, and so just sort of the gas market, and just a tiny bit on that, and then also the Driftwood economics. Right, this would be the fundamentals on a global basis. Did my best Sharif Suki impression, which, by the way, it's been a while since we had a coffee talk, and wouldn't that be nice to have one? Something that give us some substantial update about the company. But anyways, that is what I'm going to be talking about today. Before I begin, let me remind you that I'm not a financial advisor or a financial professional of any sort. All opinions that I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in Tellurian, so this video should be for your entertainment purposes only because I could be wrong about everything I say in this video. You need to do your own research before making any investment decisions. All right, so overall, I've gotten a number of folks who have asked me about Tellurian. It seems to be, I think, probably the number one stock that viewers of my channel so far actually are interested in. And I've had a lot of people pinging me recently about, what's going on. And, of course, who knows, right? The whole market is not doing great, but, Tellurian is hurting, I think, more than a lot of other companies. And really, I think the recent developments just sort of show the total lack of progress, of moving anything forward on Driftwood, anything new. There's been nothing new there, and I really think this represents all the optimism sort of being gone out of the stock, right? I think folks are not really giving them much credit at all for Driftwood in the valuation of the company. And I think there'd be, you know, a couple of reasons for that. One is just it is at this point very uncertain and pushed out to an unknown point in the future. So, if you're putting in your discounted cash flows here, and you're going to have a very high discount rate on this because your risk-free rate has gone up, and also at the same time we don't actually even have a date that you can put in there, right? Because things have not really kept on any schedule, and it's not obvious when they're going to actually get back to a concrete timeline. So you're discounting this to some very far date in the future. You might be, I think 2027 at the current moment, is your most optimistic timeline, but could it be 2028, 2029, or, never, right? Folks are just effectively opting for some of those latter answers and not really giving them credit for Driftwood, I think, very much in the valuation. So that's kind of my read on it. And this also, as I've said a number of times, I think, your plan B, your fallback valuation for Tellurian really should be as a natural gas producer, and natural gas prices have also come down. So that is also, those factors together just sort of have pushed the valuation down. So anyways, let's get into a couple things. So there was the recent amendment to the Gunvor agreement, right? This is, I think, the most salient recent thing that has happened. And, you know, just real quick before I, don't want to, bait and switch it here, but like, I really don't know what exactly they're doing here, right? So the actual changes to the amendment, the 8K did a pretty good job of summarizing it. You can actually go in the filing and read the actual amendment here. I don't know why it's not loading here. I had it, they have the actual amendment here. You can read it, but the 8K did a good job of summarizing it. And the most important points out of here are basically the number one most important is that they made it so this is really effectively not binding anymore. Either party can terminate this at any point, and they're even Tellurian is going to give Gunvor 5 days of notice when they are about to meet the conditions, and then they can terminate it immediately if they want, right? So even when Driftwood's right about ready to get everything and make it into a complete binding agreement, I think at that point, Gunvor can say, yeah, actually we change our mind, right? So this is, in my opinion, not really a binding contract anymore. Seems like, both sides maybe are keeping it around just because they might want to do it in the future, but it's not actually, we've seen how this has worked out in the past, other things, or the MOU that they had with, Petronet being the one that burned a lot of us. We've been in the stock for a while. So, that really wasn't great. One other interesting bit here was they took out TTF, right? So previously, the sales and purchase agreement that they had was indexed to a price that was partially based off of the JKM LNG index and partially based off the TTF index. And they got rid of TTF out of this, right? And they said, well, we're only going to do this off of JKM. And that was pretty interesting. I assume that's because Gunvor probably says, we don't want to have to buy at TTF prices. Maybe we really only want to sell at the places that would be more in Asia rather than Europe. I don't exactly know. I haven't done enough research to know where Gunvor does their operations, but nobody really wants to commit to buying at TTF prices right now, given where they are, which we'll look at in a couple minutes. And then maybe the most interesting, maybe it means nothing, I really don't know, the perplexing, at least, bit here is that they pushed out the deadline by 1 month, right? And this was interesting for, I think, two reasons, right? Number one, it immediately raises the question of what do we think is going to change in a month? And I'm really skeptical that a whole lot is going to change in January. So I'm not sure what the significance is of extending this for 1 month. It's also a bit perplexing because in the prior sales and purchase agreements that they had with, Shell, for example, that one was dated to, the condition precedent date was at the end, I think, of, I want to say July 31st of last year. They didn't hit that. And they didn't extend it, but they also didn't cancel it immediately, right? They sort of had it in this state of limbo where the agreement still kind of stood. They even did some small amendment to it, if I recall, but they didn't actually cancel it outright until a couple months later. And so it's interesting here that they explicitly extended the conditions precedent deadline, but they didn't. But it was only for a month, rather than just kind of letting it stand like they did for the other contracts. I don't know. It's interesting. I really have no answers here, only questions. So if anybody else really has something concrete there, I would love to know what's going on there, but I really don't. A couple other things in that they did on the same day was they kept open their at the money stock agreement. They've had this around for a while. They were using this and then they stopped. They didn't really use this for most of last year, at least that we know of. Right, we haven't had the Q4 report yet. They have no specific proceeds for this offering, as they never do. This is just a general corporate working capital purposes, I think they'll call it if you read through the actual prospectus. And it just seems like they're keeping their options open here in terms of how they want to finance things in the future. I do have a little bit of comfort here knowing that management owns the stock, and so when they are actually diluting here, they're diluting their own shares in the company. So that is at least one thing that helps me sleep a little better at night, knowing even that they have this out there. They also canceled their at the money bond program. I don't know exactly where it's listed at in here. I guess it's down here where they canceled their right down here, their 8.25% senior notes due 2028, right? They canceled that offering. They said the company no longer expects to sell securities pursuant to either agreement. Right, this is their old at the money offering with B. Riley Securities, but really, they made a new one of those just with another counterparty, and I don't know enough to know the differences between those, but it's this one with the Credit Suisse bonds, right? That's the actual bonds, I think. Yeah, sorry, I'm gonna mix up. It doesn't matter which one, but right, they canceled this, and that's I have to imagine they did that because the bonds are trading at 17.90 for a $25 par value, and they're basically only every time they do this they're killing their balance sheet, right? They're bringing in significantly less cash, 30% less cash roughly than what they're putting on in terms of liabilities, and they're paying 8%, and they probably they probably just didn't want to kill a balance sheet and continue issuing through those. So that makes sense to me that they wouldn't want to do that. Now let's take a look at I did an update on my prior model of Tellurian, sort of the gas production cash flows that we might see in 2023. And everything here is exactly the same except for the new forward estimates based off of the actual futures. of Henry Hub prices. And I actually saved the old Henry Hub prices here. Let me make this a little bit larger to hopefully make it easier for you to see. I kept in the rows in the spreadsheet where I had done this in the past, and I had the values for as of June 24th last year, as of September 25th last year, and as of January 8th today. And this is all pulled from the CME Group futures contracts for every month. And you can see back in June for 2023, the estimates across the year were in the $6, $5, $4 range, right? And you can see in September, $7 and $6, $5, right? Pretty close to $5 for most of the year. Now, as of today, when you look at it for this year, for 2023, now it is, the high point in January is, $3.75, and it goes down into the threes for all year, and it hits $4, but by next November and December. But these values are roughly 2/3, almost a half at point of what they used to be. So clearly we can see that I guess I have a chart here, but you can see that the Henry Hub prices are down, therefore their revenue in 2023 is going to be down, and their EBITDA is going to be much lower than it was. Oh man, it didn't save my settings. I guess it in the refresh. Let me change this to the daily chart, and so you can really see here what happened. Maybe something a little shorter, 4 hours. Yeah, so you can see starting in actually that this goes all the way back to it's not really going back to September. We do the daily, you can see back in September, that September 25th number that I had, I think this is the last time I did a video on it, you can see we were right here. And so that's where this is for February. It's just for 1 month, picking it out of all of them. You can see where back in February, or in September of last year, for the gas futures for next month, for February 2023, you can see those are about $7 here. And now it's all the way down here at, 3 something. You can't even see because the volume numbers tick up into those, but you can see it's just fallen down off a cliff over the past month or so. And as I said, that I think reflects in sort of the performance of the stock, and also reflects in the estimates of our EBITDA. And I think they're going to basically be at neutral cash flow for the year, almost. Maybe make a little bit of money, but for a lot of the year they're going to be pretty neutral here, if you actually count for the gas development expenses. If you kind of subtract that off, right? Because if you're looking at EBITDA, I think we're looking EBITDA per quarter here of in the 40s, 50s. Maybe they'll have a better Q4, because those numbers are a little bit higher in terms of Henry Hub prices. But across the year, we're looking at more like, my current estimate with this model is $222 million of EBITDA in 2023. And that is, again, excluding anything from Driftwood. But I guess EBITDA wouldn't matter anyways. But if we're looking at that, right, that's a lot lower than the prior estimate of almost $400 in EBITDA, over $400 in EBITDA. And so I think that's a large portion as to why the stock is trading where it is. And the market's just valuing it properly in terms of their actual cash flows here. Their projection of cash flows is just that much lower. So unfortunately, that seems to be where it's at. Now there's one asterisk here that might give us a little bit of benefit, or a little bit more in terms of revenue and more profit. And that is, if you looked at their Q3, they did have some open hedges, right? And they say, I copied it out here, the company's open positions as of September 30th, 2022 had notional volumes of approximately 14.7 BCF, with maturities extending through October 2023. Right? And so this was at the end of September of last year. So, if we look at those numbers were significantly higher than they are today. I think that's going to be somewhere between 10 to 15% of their production for next year. So it's not huge in terms of the volume, but, on 10% of their production, 10 to 15%, somewhere in there, we might see that they, locked in prices through, effectively through those hedges that are much higher than what the prices are, as of today. So that might be one small place where we'd see some upside potential in these numbers, even if natural gas prices, are flat from here. And of course, we always have natural gas prices could go back up this year. And, if that were to happen, of course, their EBITDA would go up. So that's, getting back to kind of as I'm looking at the stock, I'm still looking at it from this perspective, which is my downside risk is their gas production and those cash flows, right? That sort of valuation. That's, I think, kind of a low downside at this point, just in my personal opinion. Again, not financial advice, but that's how I'm looking at it is, they're valued at $1 billion almost exactly. And if you look at, I think they're going to make over $200 in EBITDA this year, right? That's a, less than 5x EBITDA multiple. And that seems pretty reasonable for a downside protection when you're looking at the, potential future of Driftwood being built in those cash flows, right? And so let's talk about that just for a minute. Here's the update on the Henry Hub, JKM, and TTF, right? So I have the larger graph that spans all the way out from 2023 through to 2028, and the lines here show the spreads. The actual bars show the JKM and TTF prices, except for the blue area down here shows Henry Hub. And this graph, there's just too much on here, I think, probably really for you to see on the chart. The takeaway here is TTF prices are still through the roof, even all the way out through 2028. They're at, $30, $35 or something, and for the next year or two, they're still massive, just very high. JKM prices are much lower, but still significantly above Henry Hub. And so the green line here represents the JKM spread, which is how much higher JKM is, JKM minus Henry Hub on a monthly basis. So just to make this a little easier to read, I did this chart. Let me see if I can zoom in even more, make it a little bit nicer for you to see here. So this chart shows just 2027 and 2028. I think this is relevant, most relevant for Driftwood, because this would, on an optimistic timeline, if they get things locked down soon, get construction, started in earnest, and, are able to start delivering gas for phase one in, 2027, this is a time period that's relevant for us when we start talking about those operating cash flows. And you can see here again, TTF prices are very high, but even if we just look down at JKM here, the green line is the spread between Henry Hub and JKM, and you can see this is somewhere in the $7 range. To look at it even better, if I just look at, whoops, I don't know why this chart title is wrong. This would be like JKM spreads on a monthly basis for 2027 and 2028 as of today. So if I look at this chart is sort of a stacked area here where you see the blue is the JKM spread. This is the actual profit you'd have on JKM. And then this red bar, or the red area here, represents what the Henry Hub is in that month. So you can see here the actual JKM spreads, the profits of, if you were able to just sell at JKM and buy at Henry Hub and there was no other costs or expenses involved. This blue area here represents what that spread would be. And so you can see this really is, in the $6-7 range for all of 2027 and 2028. I actually have the numbers here. And I have an average. I actually computed the average for each year, and it surprisingly comes out almost exactly to $7 in 2027 and almost exactly $6 in 2028. So again, I know this video is getting kind of long, but what I wanted to do was, just give you a quick update on the macro for LNG and for these spreads here, so that we can kind of validate this model here, right? This is the model, the super high level projection of cash flows for Driftwood that, the Tellurian has published since, I don't know, 2017 or 2018, since multiple years ago. And, the math still makes sense. The macro environment still supports it. And so if we're looking at this, we see, if we're looking at $7 spreads, right? $7 spreads minus, let's be conservative and say there's $2 for transport. That gets us an actual $5 spread. In here, they estimate $1 for their own liquefaction and transport costs. Subtract off another $1, that's $4 of margin, right? So again, this is not even as high as they're using here, because they're using 50-50. If you read the footnote here, it says 50% TTF, 50% JKM, with estimated $1.50 per MMBTU of transportation costs. Again, I am being more conservative. I'm looking at only JKM, and I'm assuming $2 per MMBTU for transportation costs. But if we look at that, that's still $4 of margin. Multiplied by their 550 BCF, and you get $2.2 billion per year in annual operating cash flows. So that is pretty substantial, right? You assume Tellurian might own, let's say, 40% of it by the time this rolls around. Again, you're looking at phase one cash flows in, if they were producing for all of 2027, hypothetically, you're looking at $880 million of operating cash flow to Tellurian, right? And so you can again take a look at what you think it might be in future years as well, discount that back, and this still is a large number, right? So this is me saying my personal opinion is there is still significant upside potential, right? Driftwood still makes sense. The economics still work out. There's still a spread between these that's big enough to support this whole project. And I think being able to, buy at these levels in Tellurian where it's basically fairly valued as a gas producer and Driftwood really doesn't factor in here when there's seems like to be practically no optimism for Driftwood happening, and seemingly no real credit given to Tellurian in terms of valuation for Driftwood. I think this is I am looking to increase my position at the current moment. Let me just say that. Again, not financial advice, but that is the way that I'm looking at this. I see it as an asymmetric upside versus downside bet. So that is my current opinion on the stock, and just a quick update on some things that have happened recently. So hopefully that was helpful to you. I do not see anything on the chat for today, so I'm going to hop off. By the way, if you're still watching, I am going to attempt to try to do a stream every Sunday evening, and then maybe Wednesday or Thursday evening, being Eastern US time, hopefully around 10 p.m. Can't guarantee that, but that's my target, to try to be a little more regular. Sunday, I'm going to try to definitely keep that for as many Sundays as I can this year. So that is my plan. We'll see how well I can stick to it, but that's what I'm hoping to do. So thank you very much for watching, and have a good one.